Hi, everyone. Thanks for being here today. It's just a minute or two after 2 here, so I think we'll get started. We still have a few more people joining, but we might as well start. Today's webinar is Planning for the Sunset, a look ahead at the expiring tax provisions. I'd like to thank everyone for being here today. My name is Jolyn Sweet, and I have been with Atlas as the tax director for almost a year. I have over 15 years experience in tax preparation and tax planning, and I work primarily on individual tax returns, as well as trust and estate fiduciary returns, and estate and gift tax returns too. My experience includes working on taxes for high net worth individuals and families. I was at a law firm for the past 9 years before coming to Atlas, and I was with a financial services firm before that. I've also worked with clients in the areas of estate and trust administration and the tax implications of settling estates and administering trusts. Here at Atlas, our tax projections include anything from calculating estimated payments and withholding adjustments for payroll and retirement distributions to planning for selling a home or a business, exercising stock options and restricted stock, and incorporating charitable and gift planning. We also prepare estate and trust tax returns as well as estate and gift tax returns. The purpose of this presentation is to provide general information and is not meant to offer any specific tax advice. I'd like to note that we welcome your feedback and your questions. However, this presentation is not going to include a live question and answer feature. At the end of the presentation, we'll give options for a survey, for feedback, and contact information for questions. Everyone's tax situation is unique and should be reviewed with your own tax advisor. I work directly with Brendan Walsh, and for those of you who are Atlas tax clients, I may have worked on your 2021 returns or on your tax planning. My role at Atlas is to prepare tax returns for our clients and to work with the financial advisors on tax advice and tax planning. Sometimes I attend client meetings with the advisors, and sometimes I prepare projections and other materials for the meetings. I'm always available for questions and to help identify planning opportunities. For clients I haven't met yet, I look forward to working with you in the future and answering any questions that may come up. And for those of you who are not Atlas tax clients, I hope you find this informative, and I encourage you to reach out to me or an Atlas advisor if you have any questions. Today's agenda, in this presentation, we will cover what the expiration or the sunset means and why it's happening. We'll review the provisions of the tax laws that are changing. And finally, we'll talk about what we can do to plan ahead and be prepared now. So what is a tax sunset? Back in 2017, a year after President Trump was elected, he signed into law the Tax Cuts and Jobs Act, which had sweeping changes to multiple areas of the tax code. Only some of the Tax Cuts and Jobs Act changes were permanent, while most are set to expire over a 10-year period, or what we're calling the sunset. As such, most of the changes to the individual tax code are effective for tax years 2018 to 2025. The purpose of this presentation is to give an overview of what will change and talk about how this may impact tax planning over the next few years. Oftentimes, we don't want to spend too much time speculating on proposed legislation because while it's always a good idea to be informed, things can always change in a final package that's passed, if it even passes at all. The sunset provisions are different because this is what's going to happen unless new legislation is passed. It's certainly possible new legislation passes to keep or change some or all of the provisions in the Tax Cuts and Jobs Act. However, with the midterms happening now and another presidential election in 2024, before many of the provisions are even scheduled to sunset, who knows what the political landscape will look like. We like to be proactive as opposed to reactive. So as we navigate through the fourth quarter of 2022, we wanted to take some time to look ahead at the expiring provisions and think about any planning opportunities that we could take advantage of now. The Tax Cuts and Jobs Act reduced the income tax brackets while also slightly increasing the income levels for the brackets, which generally resulted in reduced taxes for many individuals. Certainly not everyone had a reduction in taxes, but as you can see on the slide, which bracket you would be in based on your taxable income in 2017 versus 2022. The highest tax bracket is going to go from 37% back to 39.6%, and the income levels are reduced, meaning that, for example, a married couple hits the 24% bracket at almost $180,000 of income in 2022 versus hitting the 25% bracket at about $76,000 in 2017. That same $76,000 would be in the 12% bracket in 2022. The sunset provisions will bring us back to the tax rates of 2017. However, the income levels will not be the exact same amounts in 2017. They'll be indexed for inflation. Tax brackets are determined by taxable income, not adjusted gross income. Taxable income is adjusted gross income minus allowable deductions. So an important part of the calculation to determine the tax bracket is the amount of the deduction allowed. The Tax Cuts and Jobs Act changed the standard deduction for individuals, nearly doubling it. At the same time, personal exemptions were suspended, which we'll discuss in more detail in a minute. Prior to the Tax Cuts and Jobs Act, almost a third of taxpayers reported itemized deductions, and that percentage has dropped to only about 13% since the Tax Cuts and Jobs Act was passed. Since many taxpayers will be going back to or will start itemizing deductions after the sunset, we wanted to review some of the more significant changes. You may have heard or seen the term SALT, S-A-L-T, in connection with itemized deductions. This stands for state and local taxes, which includes taxes on income, real property, sales, and personal property. Tax Cuts and Jobs Act limited the deduction to $10,000 per return per year with no carryover provisions. And that's per return, so whether it's a married filing joint or a single return, it's a $10,000 cap. For states like New York with relatively high income and property taxes, this was a significant change, and many taxpayers were no longer itemizing their deductions, largely due to this $10,000 SALT cap. Prior to the Tax Cuts and Jobs Act, mortgage interest on up to $1 million of acquisition indebtedness and up to $100,000 of home equity line of credit indebtedness was tax deductible. The Tax Cuts and Jobs Act reduced the mortgage indebtedness to $750,000 total, including home equity line of credit. And the home equity line of credit has to be used for improvements or repairs in connection with the property that the loan is tied to, so not a vacation home or a rental property. After the sunset, it's going to go back to the $1 million of mortgage plus the $100,000 of home equity line of credit. It gets more complicated with regular tax and AMT calculations, but it's worthwhile to note that for the regular tax calculation, the home equity line of credit will not necessarily need to be used for home repairs or improvements. It's tax deductible regardless of what it's used for. The Tax Cuts and Jobs Act raised the AGI percentage limitation from 50% to 60% for cash contributions to 50% organizations. 50% organization is what many of us think of when we're thinking about making charitable contributions. These organizations include churches, educational organizations, hospitals, and medical research organizations. The AGI percentage limitation means that one cannot donate more than a certain percentage of their AGI, which right now is 60%, and have it be tax deductible. So for example, if your adjusted gross income is $100,000, then the limitation is $60,000 to have for tax deductions. In 2021 only, that limit was increased to 100% for these organizations. For 2022 to 2025, that limitation remains at 60%. The other limits of 50%, 30%, and 20% for other types of property, such as stock donations, to other types of charities, such as private foundations, remain unchanged with the Tax Cuts and Jobs Act. For taxpayers considering large cash donations, it makes sense to plan for the timing of these donations, especially if income variances are expected over the next few years. Medical expenses are tax deductible in the year paid, regardless of when the expense was incurred. Medical expenses in excess of the 7.5% of AGI floor are deductible as itemized deductions, and the AGI limit applies for both regular tax and AMT calculations. As mentioned earlier, AGI is adjusted gross income, and the AGI floor means that only expenses that exceed 7.5% of AGI are deductible. So if your adjusted gross income is $100,000, then the first $7,500 of medical expenses are not deductible, but anything over that amount is an itemized deduction. The 7.5% floor was made permanent by the Consolidated Appropriations Act of 2021, and it's not going to be subject to the Tax Cuts and Jobs Act sunset provisions. 2% miscellaneous deductions are a long list of items deductible over the 2% of AGI floor. Same as the medical expenses AGI floor, this means that only expenses that exceed 2% of AGI are tax deductible. This list includes investment expenses, tax preparation and advice fees, legal fees for producing income or tax advice, professional and union dues, and safe deposit box fees. Investment management fees on taxable accounts are deductible. However, investment fees on retirement accounts and tax-exempt income accounts, such as a muni bond account, are not deductible. What's also included in the 2% miscellaneous deductions are employee business expenses, including home office expenses for employees with W-2 wages. Currently, employee business expenses and home office expenses are deductible for independent contractors and for business owners and partners, but not for those who have W-2 wages. In order to be considered a qualified home office, the area in the home must be used regularly and exclusively for business. The business use percentage of the mortgage interest, real estate taxes, utilities, and other expenses can be deducted, as well as the direct expenses related to the home office. There's also a simplified method for computing the home office deduction. The home office still needs to meet the criteria of a qualified home office, but the deduction is just an amount per square foot. In 2021, that amount was $5 per square foot up to 300 square feet. Casualty and theft losses are also included as itemized deductions. They will be after the sunset. They are currently suspended. However, there is a caveat that they are reportable if they are attributed to a loss in a federally declared disaster area. Some states, such as New York, have decoupled from the federal on itemized deductions, and they're still allowing deductions for 2% miscellaneous items. So for New Yorkers, it's still important to keep track of these miscellaneous expenses since they may make an impact on the New York income tax return, even if they're not reportable on the federal income tax return at this time. Before the Tax Cuts and Jobs Act, itemized deductions were reduced by 3% of the amount of AGI that exceeded certain thresholds. This is known as the PEAS limitation, named after the congressman who helped create it. And it effectively limited the amount of itemized deductions that certain taxpayers could claim. Prior to the Tax Cuts and Jobs Act, the threshold for the PEAS limitation was just under $315,000 for a married filing joint taxpayer. The maximum reduction is 80% of itemized deductions. The Tax Cuts and Jobs Act suspended the PEAS limitation, but it will come back after the sunset. There's some other changes coming with the sunset that we're going to discuss. AMT is a separate tax calculation using a different set of rules than the regular tax calculation. Tax returns already calculate both regular tax and AMT, and the taxpayer owes whichever is higher. The Tax Cuts and Jobs Act increased the exemption levels and increased the income level that the AMT exemption phases out. Tax Cuts and Jobs Act also eliminated the 2% miscellaneous deductions and limited the state and local tax to $10,000 cap, both of which affect the AMT calculation, and which are often a factor for how many taxpayers end up in the AMT. After the sunset, due to the fact that we're going to go back to the lower exemption and income levels, and due to the fact that the 2% miscellaneous deductions are back and there's no longer going to be a SALT cap, more taxpayers will likely find themselves in the AMT. Personal exemptions, many of us remember those. They were suspended with the Tax Cuts and Jobs Act. The exemption amount has been indexed for inflation, and in 2016 and 2017, the personal exemption was just over $4,000 per person. The exemption is subject to phase-outs starting at certain income limits. Personal exemptions are back after the sunset, and we'll have to wait and see the amount of the exemption and the AGI levels for phase-outs. Section 199A is a new concept with the Tax Cuts and Jobs Act. It is the qualified business income deduction. Individual taxpayers can deduct 20% of qualified business income on their individual returns. This mainly applies to taxpayers who are sole proprietors in partnerships or have LLCs or S-corps. It does not change the AGI. It is a deduction from the profit from business income. Section 199A is set to expire with the sunset. The child tax credit changed with the Tax Cuts and Jobs Act, and it has changed again since then. Prior to the Tax Cuts and Jobs Act, the credit was $1,000 per child under 17 years old. Tax Cuts and Jobs Act doubled the credit to $2,000 per child and also added a $500 credit for older children and other dependents. The American Rescue Plan Act of 2021 temporarily increased the child tax credit and made it refundable for certain taxpayers. Legislation has been proposed in 2022. However, the child tax credit is currently $2,000 per child, and the advanced child tax credit payments were only in 2021. The phase-out levels for the credit also increased with the Tax Cuts and Jobs Act. Without any new legislation, the child tax credit goes back to $1,000 per child, is non-refundable, and the lower AGI phase-out levels will apply with the sunset. Bonus depreciation is another provision that changed with the Tax Cuts and Jobs Act and has also changed again since then. Tax Cuts and Jobs Act increased the special depreciation allowance from 50% to 100%, and it eliminated the requirement that the property had to be new to qualify. The percentages for bonus depreciation start to phase out at the end of this year. 2022 is still 100%. Then it reduces by 20% each year until it is at 0% in 2027. Bonus depreciation is eligible for qualified property the year it's placed into service. In general, qualified property is new or used property with a recovery period of less than 20 years, and it does not include property acquired and disposed of in the same tax year. Some of the biggest changes with the Tax Cuts and Jobs Act were in the areas of estate and gift tax. When an individual dies, the size of the estate is measured by the individual's gross assets. This includes all individual assets, retirement accounts, life insurance proceeds on the deceased person, and half of all property owned jointly with rights of survivorship. Gross assets include both probate and non-probate assets. Even if a revocable trust owns a bank account or if a beneficiary is named on a retirement account, it all counts for the gross assets calculation. If the gross assets are over a certain threshold, then there's a filing requirement for an estate tax return. In 2017, that threshold was $5.49 million. Now in 2022, that threshold is $12.06 million. The threshold is indexed for inflation, and it will continue to increase through 2025. It'll go back to about $6 million in 2026. We don't know the exact figure yet. The highest tax rate is 40%, so some estate planning may be prudent if you expect your assets to be near the $6 million range in a few years. $6 million is a big number, and many couples may not think they're going to be in that range of assets, but it's important to consider factors like appreciation on real property, growth on taxable and retirement accounts, and the idea that it is usually after the first spouse has passed away, and the surviving spouse is the sole owner of their own assets, plus the assets inherited from the spouse who died first, when thinking about estate planning considerations. Portability is when a surviving spouse inherits the deceased spouse's unused federal estate tax exemption. Each person has his or her own exemption. That's the $12.06 million number in 2022. Generally, marital assets passing from one spouse to the other do not use any exemption. So if a husband and wife own everything jointly, or if they leave everything to one another as beneficiaries or in their wills, then no exemption will be used when the first spouse dies. The surviving spouse or the executor of the estate can file an estate tax return to make an election for portability of the deceased spouse's unused exemption. In 2022, a surviving spouse could increase his or her federal exemption to over $24 million. The only way to elect portability is on a federal estate tax return, the Form 706, which is due 9 months after the date of death. Portability does not expire with the sunset, and it will continue to be available to surviving spouses. Portability is a concept for federal estate taxes only, and it does not apply to state estate taxes. Some states have their own separate estate tax. New York has its own tax, and the gross assets threshold is $6.11 million per person in 2022, and that is indexed for inflation. Massachusetts has its own estate tax, and the gross assets threshold is $1 million, and Mass has been at the $1 million threshold since 2006. It's possible to have a state estate tax filing requirement or multiple state estate tax filing requirements, and at the same time not have a federal requirement. There are 12 states and the District of Columbia that have state or inheritance taxes. The gift tax annual exclusion in 2022 is $16,000, which means that an individual can give up to $16,000 to any other individual in 1 year. and that exclusion has actually increased to $17,000 for 2023. Making payments directly to medical institutions or to educational institutions on behalf of another person do not qualify as gifts for gift tax purposes. If a gift over $16,000 is made in 1 year, then there may be a gift tax filing requirement. Each person has a basic exclusion amount. It is first used during life to offset taxable gifts, and any remaining exclusion is used at death for estate tax calculations. In 2022, that exclusion is the $12.06 million per person. Gifts in excess of $16,000, which are considered taxable gifts, will erode the gift tax exclusion, and tax would be due only if an individual's entire gift tax exclusion was used up during life. The donor would pay gift tax if their exclusion had been used up, but the person receiving the gift does not pay gift tax. When an individual dies, the exclusion used during life goes against the estate tax exclusion for purposes of calculating the estate tax. There are complex rules around the timing of gifts being included in a gross estate for both federal and state purposes, as well as for Medicaid purposes. So it is always a good idea to consult an attorney or a tax professional before large gifts are made. The IRS has said that there are no clawback provisions for large gifts made prior to the sunset, even if the donor dies after the sunset when the exemption levels are lower. Again, there are vast planning opportunities for people considering gifting and estate planning that may be a good idea to start thinking about well before the sunset provisions are set to change. These types of sophisticated planning do not usually move fast, and they will likely include financial planning, tax planning, and probably legal documents, so it is not too soon to revisit your estate plan, especially if you're thinking about any gift planning. So all of these complicated changes will happen in a few years. Why should I care much about any of that now? What would I do differently? Well, you may want to consider accelerating income now while you're potentially in a lower tax bracket and tax rate. If you have stock options on the table or restricted stock, we should review the vesting schedules and think about developing a plan for exercising shares. Maybe you have an inherited IRA that needs to be distributed within the next few years. A Roth conversion or a series of Roth conversions over the next few years may make sense, or recognizing other income now versus after the sunset. At the same time, you may consider maximizing your deductions and figuring out if you'll be itemizing after the sunset. If you do itemize, do you expect to be an AMT? If you make charitable donations, it may make sense to consider bundling deductions into 1 year, or think about making a donation to a donor-advised fund. Maybe making donations directly from your IRA to satisfy some of your required minimum distribution is a consideration now, especially if you're not itemizing. Do you have an idea of your gross estate? Do you know if you're subject to estate taxes in the state that you're living in or that you're considering moving to? Do you own property in other states? Owning property can trigger an estate tax filing requirement. So even if you move to a state without an estate tax, there could still be filing requirements in other states. Maybe you're considering doing some significant gifting now, funding 529 plans, gifting business interests, cash, or other assets. It may be worthwhile to talk to your tax advisor for planning strategies, including how the step-up in cost basis works when a beneficiary receives property versus how the cost basis is transferred when the property is gifted. The idea is making sure that what you're doing now is suitable and you're planning ahead for how these tax law changes may impact you. The opportunity to plan ahead allows us to be proactive. Estate planning, gifting, financial planning, and taxes all go together and should not be considered in a vacuum. One size never fits all, and it's important to talk to your Atlas advisor, your tax professional, and your attorney to make sure all of these complex areas are in line with your overall goals and objectives. We want to be sure we're considering all of the relevant factors, such as moving to another state, owning property in multiple states, retirement, RMDs, starting or closing a business, and of course, what your goals are. So this wraps up today's webinar. I want to thank you for attending. I hope you found some useful information to think about for your own tax planning. I'd be happy to answer any questions by phone or email if you'd like to contact me. My information is on the Atlas website and the phone number is on the screen. feel free to reach out to me at any time or your Atlas advisor to discuss any tax planning strategies or opportunities.